Hey guys, Walkie here. I just wanted to hop online briefly and address a question that seems to be coming up more and more with a lot of my buyer clients as they are out there in the real estate market and they're trying to get a home bought and they realize it's super competitive. And so some of them have started to ask recently, when are we going to see the prices crash, right? When are we going to see that repeat of 2009 where the housing market starts to tank and I can get a house for a decent amount? They see the prices going up now. They realize it's a very competitive market to try to buy a home in. And so in their mind, it feels like maybe we're pushing in on the 2009 scenario again. And so I just want to hop online and kind of talk about that a little bit because we truly are in a fundamentally different market than we were back then. And I think it's worth sharing some of the data points, some of those metrics so people can understand where we're at. So when you evaluate a real estate market, obviously there are many different factors that go into determining the health of the real estate market and any market in general. I'm going to hit some of the high points of those metrics, and I'm going to do my best not to get super technical because some of it can be a little nerdy. I'll try to keep it pretty simple for everybody. So there are things like inventory numbers, right? How many homes are actually on the market for buyers to buy? How many sellers are out there trying to sell a product, i.e., the house, to a willing buyer? There are things like what does it cost to make that transaction happen, right? Interest rates, prices, all of those factor in. You can't just look at what's a dollar amount of a home price because you also have to factor in the mortgage interest rate on that, what's the term of the mortgage, and other factors as well. But mortgage interest rates are a big part of that, obviously. Then you have things like the regulatory environment that we find ourselves in. How hard is it for a buyer to get a loan on a house now, vice what it might have been before? And how does that change the overall strength of the market based on the ability for someone to secure a safe and secure mortgage? Um, Things like equity and how much equity do sellers currently have in their homes? The way that we handle a homeowner who can't necessarily afford their mortgage at the moment, the way we do that now versus the way we did that back then is pretty different. So there's a lot of different factors. I'm going to hit some of the high points, and hopefully by the end of this video, it'll kind of put any buyers at ease about where we're at in the market. So let's just hit some of the high points. Let's look back to about the 2006 to 2009 timeframe. And let's do kind of a compare and contrast of where we're at right now. So let's start with inventory because everyone knows the basics of supply and demand, right? If I have a whole lot of something and there's not a lot of demand for it, the prices can't be high. In order for me to sell that product, it has to be low. On the flip side, if I have very little of something and many people desire that thing, the prices can come up because supply and demand says if I have something that you want, you'll pay more for it. And so in the real estate market, one of the metrics that we use to gauge that supply and demand is called months of supply. And months of supply is a simple metric to say if there's no more houses that hit the market at the rate they're going under contract, how long does it take to sell them all? And in the 2006 to 2009 timeframe, we had anywhere from about 9 months of supply upwards of about 13 and a half months of supply. Meaning, if everybody just stopped putting houses on the market, it could still take a year for all of the buyers out there to buy those properties. All right? That's a lot of supply. Now, contrast that with where we're at right now. We actually have a national inventory shortage. We are at historic low numbers for homes available to be bought on the market. Nationally, we're at about 1.2 to 1.4%. I'm sorry, 1.2 to 1.4 months of supply, depending on exactly what month of the year you grab. In the Central Virginia region, I'm seeing counties that are less than 1 month of supply. That is a super tight inventory for a whole lot of buyers that want to purchase. And so those prices naturally have to come up. And that's what we've seen the last year or two. Prices are starting to come up because there's just not enough supply to meet that demand, which again, drastically different than what we saw in the pre-2009 timeframe. Another metric is mortgages. What was the interest rate on your 30-year fixed rate mortgage then versus now? Because that metric is key in determining your actual buying power. So if we look at 2006 to 2009, on average, we were somewhere in the realm of 6 to 6.5% on a 30-year fixed rate mortgage. A little bit more, a little bit less, depending on specifically what month and where we were at. But on average, 6 to 6.5% for a 30-year fixed rate mortgage. We're right now just getting back, we're scraping above the historic lows. Once again, we're getting back into that 3% range and sometimes still less than 3%. We closed a VA buyer recently at 2.75 still. Um, and while it doesn't sound like a lot because you say, well, 3% isn't that much smaller than 6.5%, that's actually a huge amount of buying power that the purchaser has right now that they just didn't have then. So the cost to own a home, even though the dollar amounts have come up to meet supply and demand, the actual cost to buy it long term of the mortgage is actually pretty cheap still. And there's a lot of buying power available to those buyers that are out there. So that's a good thing, and that keeps the market moving in the right direction. Let's talk a little bit about um, home price appreciation. That means year over year, how much value is being added to my home's to my property, to my house, call it, value. Um, 2006, 2009, we were averaging somewhere between 8.5 to 12.5% year over year price appreciation for each of those years. Now, if you take a chart of 100 years of the real estate market, right, long-term trends, 3 to 5% annual appreciation is a normal, healthy market. To see 3 to 5 times that number year over year for multiple years obviously was not a sustainable, healthy price increase. If you look at the last 5 or 6 years up to where we are now, we saw more in line with about a 4 to 6, maybe 6.5% year over year price appreciation, which is far closer to the national historic trends of what a healthy real estate market looks like. Now, you could argue that if you look at last year, January to 2020 to January 2021, we saw roughly a 12 to 13% year over year price increase on the median sales price. That's pretty stout, but that's 1 year out of many. And the run up to that was very normal in a good, healthy market. Another piece of why we saw the prices go up so much this last year is one, the supply and demand metric, that there's no inventory, so prices naturally have to rise. And the other one is inflation. When you have more money being printed to pay for disaster relief and other projects, naturally that money has to be printed from the treasury, and that causes the value of everything to start to creep up as inflation does what it does. So the cost of materials to build a new house has gone up significantly. That means the cost to sell a house is going to go up, the cost of gasoline is going to go up, the cost to own things goes up, and that's not necessarily an indication of a healthy or an unhealthy real estate market. That's simply a matter of economics. And as we fight coronavirus, as we push new bills to do new things and they cost money, and we start printing that money, that does cause inflation to happen and prices will go up as a result. Quick example of that, if you look at January of 2020, the M1 money supply, which is the Treasury's metric of one of the three metrics of money, was roughly $4 trillion. January of 2021, it was roughly $18 million, which means the amount of money being printed and circulated went up 450% in 1 year. Inflation is a natural result of all of that extra money being in circulation. There's nothing we can do about that. And therefore prices have gone up. And so that's not an indication of an unhealthy real estate market. That's simply an indication of inflation is doing what inflation does when we print more money. Let's talk briefly about the banks as well, because that's a big piece that a lot of people miss. The real estate crash was almost a tangible visual, if you will, of a bigger problem that occurred, right? Everyone says it was a real estate crash. Ultimately, it was a finance crash. It was a banking problem. And what we had was we had banks and lenders getting very, very creative with how they gave out loans. And so people who could not afford homes, they were still getting mortgages for homes. And this is kind of a scenario. This is how it would look. A buyer comes out, they want to purchase a home, and they go to their bank and say, I want to buy this $500,000 home. And we, at the time, the lending institutions had no doc loans, meaning I don't even need you to verify your income. Just tell me what you make. I'll believe you. That banker could then turn around to his buddy who was an appraiser and say, hey, Scott, hey, Joe, hey, Marianne, um, we're buying this house. We're going to give a loan to 500,000. Wink, wink, nudge, nudge, do the appraisal. Magically, the appraisal would always come back for the right amount. And therefore, the buyer got the loan with no documented income and an appraisal which was not necessarily an accurate representation of value. And that continued for years on a very large scale until eventually it became completely unsustainable. And if you remember back in this time frame, again, I say the housing crash was a tangible result. We saw that visually when people lost their homes, but we also bailed out all of the banks, which were the root cause of the problem. Those same blenders and banks kind of went over in the corner and said, don't look over here, look over there at the market crash. But it was ultimately a financing issue. It was a regulatory problem on how we were giving out loans to people who could not afford houses. We just don't do that anymore. There's a great metric that talks about the difficulty to buy a house, to get an actual mortgage to make a purchase right now. How hard or how easy is it for a buyer? And that metric is called the home equity. I'm sorry, that's called the home price uh, credit availability metric. It's not well known, but it's out there in the finance industry, and it's a sliding scale of how easy or how hard is it for someone to secure a mortgage. If you look at 2008 to 2009 timeframe, even as far back as 2006 2007 timeframe, that number was well above 800, pushing into 900. The larger the number, the easier it is to get a mortgage. So the lower the number, the harder it is to actually get a mortgage. Right now, that number is about 150. So we went from 900 down to 150, meaning it was incredibly easy to get a mortgage. You didn't even have to tell me what you really made. You just threw an application, threw an app together. We're going to make it work one way or the other. We'll get it done. Now you have to verify your income, verify your assets. You get a second verification before you close. The lenders aren't allowed to speak to an appraiser directly. There's third-party vendors that handle the appraisal so that there is no conflict of interest, and the appraised value has to be an accurate representation of the market value, generally speaking. So completely different mechanisms in place to ensure we don't give loans to people who cannot afford to have loans. That's another big metric, drastically different than what we saw then. Another big one is equity, right? How much equity do people have in their home right now? Now you say, well, who cares what the equity is if I'm a buyer? Well, here's the thing. A lot of the buyers are saying, I'll just wait for the foreclosures to start rolling in when this whole thing crashes. Well, that's just not going to happen. And here's why. There's two things. One, the banks learned their lesson from then, and they are much more willing to work with a seller, well, an owner, if you will, if they're behind on their mortgage payments, right? We have forbearance programs now. We can re-amortize their mortgage back out to a new 30-year fixed. There's so many different ways that they'll work with an owner, vice foreclose on an owner, because they realize it's not a great idea to just mass foreclose on people. Now, part of that metric is how much equity does that owner have, right? If I'm sitting with equity in my home, but I lost my job because of coronavirus, and the forbearance time frame eventually will come to an end. We've just extended it again, so there's no foreclosures happening anytime soon. But let's say down the road, those forbearances go away, And the banks are in a position where they have the option to either foreclose on me as an owner or work with me as an owner. And I say, well, listen, banker, I have lots of equity in my home. Let's just refinance. I lost my job. I had 9 months where I couldn't make my mortgage payment. I have my job now. I have an income again. Refinance my house. We'll start over. Nobody has to get kicked out. You don't have to lose money on a foreclosure. It's a win win. And that only works if owners have equity. Owners have a lot of equity right now. If you look at the metrics from just the last year or so, the average homeowner has more than 50% equity in their home, and only 27% have less than, I think, 30% equity in their home, which essentially just is a fancy way of saying there's extra money sitting on the table in resident in the value of the home that they can unlock if they refinance, if they extend their mortgage out, if the banks work with them. There's money to be made to fix the problem, pay off the forbearance issues if we get to that point, and not have to foreclose on somebody. And that's really where we're at. If you look at equity numbers back to 2006 to 2009, the amount of equity that owners actually cashed out of their homes, meaning they didn't have them in their house anymore, was about $825 billion. Right. So imagine this. Imagine this market. Houses are everywhere. Prices are going up so much year over year that you just assume I'll just buy an investment property with my equity because it's moving up so fast. I'm going to naturally make money. And so people were cashing out their own home's equity to make speculative investments that they couldn't afford. And when it all came tumbling down, there was nothing left for them to work with, and they got foreclosed on. Now, 2017 to 2019, the amount of home equity that has been cashed out is only 230 billion, and the prices have gone up substantially since 2006 to 2009. So that's a ton more equity sitting in homes than what people have cashed out. So when you look at mortgage interest rates, the amount of inventory on the market, basic supply and demand, inflation levels being what they are, equity ratios being incredibly high, and banks being in a completely different regulatory environment than they were then, it paints the picture of a drastically different market. While it is tough to be a buyer right now because there's just not enough inventory, if you're waiting it out, hoping for a crash, you're going to be waiting it out a long time. And by the time you realize this isn't going to go away, prices will have continued to go up as a byproduct of supply and demand and inflation. Um, are we going to see 12% year over year like we saw last year? No, no, we're not. That will normalize at some point. More houses are going to come on the market at some point to ease that supply and demand metric. Housing will cool off a little, and we'll get back to a normal range, 3 to 5, maybe 6% year over year price appreciation, as opposed to the 12% we saw last year. That doesn't mean prices are going to go down or start moving in the negative. It simply means that the market will cool off, but the prices are still going to be going up. So if you're a seller, it's a great opportunity to take advantage of the equity that's been built up. By all means, get out there and sell your home. Help somebody out. There's lots of buyers waiting for your home. If you're ready to move, if you're ready to downsize, if you're ready to upsize, now's a great time to make that move. Put your house on the market. If you're a buyer, just be patient and keep working at it, and understand that when you get a home under contract and you're ready to buy it, you are not going to be facing 30% drop in home value next year because the market crashed. We're just not going to have that problem. It's not the same environment. Fundamentally different market than what we had then. So your money is safe, your money is secure, as is the historical norm. Owning a home will help you build wealth. Jump in. If you're ready to move, make the move. If you're renting and you're ready to buy, get out there and start shopping. If you're ready to upsize, you're ready to downsize, go ahead and dive into this market. because it's strong, it's healthy, and it's going to work in your favor long term. If you have any questions at all, drop me a comment below, send me a note, give me a call. All my information is on my Facebook page, and I'm a pretty easy guy to find. Happy to break any of these numbers down in more detail for you. Um, get out there and make it happen for yourself, guys. Have a wonderful week. Thanks.